Growth is supposed to be a good thing. More customers, more sales, more attention. So why do so many businesses collapse right after they start growing? Why do companies with increasing revenue still miss payroll? Why do fast-growing startups shut down despite doing well? Why do founders say, "We were busy, but broke"? This isn't rare. It's common. Because growth doesn't automatically mean stability. In fact, unmanaged growth often creates financial pressure faster than profit can keep up. Today, we're breaking down the uncomfortable truth, why growth often drains money instead of creating it, and why the most dangerous phase of a business isn't decline, it's expansion. This video isn't about discouraging growth. It's about understanding the hidden mechanics behind it. We'll break down why growing sales can reduce cash, how expansion increases financial risk, why profit numbers give false confidence, and what smart businesses do differently. If you've ever wondered how a business can be successful and still feel constantly short on money, this video will make it clear. Because once you understand how growth really works, you stop chasing it blindly and start designing businesses that survive it. Growth feels like momentum, but financially, growth is expensive. More customers mean more inventory, more staff, more systems, more customer support, more mistakes. Every layer of growth demands cash up front. You often pay before you earn. You hire before revenue stabilizes. You stock products before customers pay. You spend on marketing hoping results arrive later. On paper, revenue grows. In reality, cash leaves first. This creates a dangerous gap. Money goes out now, while money comes in later. That gap is where businesses suffocate. The faster the growth, the wider that gap becomes. This is why controlled businesses grow slower and survive longer. Growth doesn't just increase opportunity, it multiplies cash pressure. Cash. Profit is blind to timing. A business can be profitable while being completely illiquid. Here's how it happens. You make a sale today. You record profit today. But the customer pays in 30, 60, or 90 days. Meanwhile, suppliers want cash now, staff need salaries now, rent is due now. The income exists only on paper. So the business looks healthy, but the bank account tells a different story. This is why founders feel confused. We're making money, so why are we always stressed? Because profit measures success eventually. Cash flow measures survival today. Growing businesses often celebrate profit right before they run out of money. Not because they failed, but because they misunderstood what success actually requires. Growth doesn't fix weak foundations. It exposes them. If your pricing is thin, growth magnifies losses. If your payment terms are slow, growth stretches cash gaps. If your expenses scale faster than revenue, growth accelerates collapse. A small business can survive inefficiencies. A growing business cannot. Growth removes margin for error. Small mistakes become large problems. Delayed payments become critical. Poor forecasting becomes dangerous. This is why many businesses fail after traction. They didn't suddenly become worse, they just became bigger. And their weaknesses scaled with them. Growth is a stress test, and many businesses fail it silently. When cash gets tight, most founders make the same decision. Let's sell more, but more sales don't automatically solve cash problems. In many cases, they make them worse. More sales can mean more cost before payment, more customer servicing, more refunds and errors, more operational strain. If each sale requires upfront spending, then scaling sales burns cash faster. This is why desperate growth is dangerous. Smart businesses don't ask, "How do we sell more?" They ask, "When do we get paid?" How predictable is our inflow? How fast can cash return? Sales volume matters, but cash timing matters more. Without fixing structure, growth is just accelerating toward the wall. Strong businesses design growth around cash flow. They collect money earlier, delay expenses where possible, stabilize inflows before expanding, grow only when cash can support it. They prefer predictable income over impressive revenue, slow growth over fragile growth. Subscriptions, upfront payments, controlled hiring, cash buffers. These aren't exciting strategies, but they work. Growth becomes safe when cash arrives before stress does. That's the difference between businesses that scale calmly and those that constantly feel one bad month away from collapse. Growth doesn't kill businesses. Unmanaged growth does. Revenue creates headlines. Profit creates confidence. But cash flow creates survival. Once you understand this, you stop chasing growth blindly and start respecting its cost. On Business Decoded, we don't explain business the motivational way. We explain it the real way. This is Business Decoded, where we explain how money and businesses really work